Hi, everyone. We've dealt with the concepts under Ind AS 111, which is joint arrangements. Right. So far, we have talked about there are two types of joint arrangements, as you would remember. One is a joint operation, and another is a joint venture. Okay. Now, what we would like to do is we would like to talk about how is the accounting treatment done in each of these categories, and importantly, why so. Okay. So all those concepts where we talked about you know the relevances of the different types of or these types of joint arrangements where we said that there is a collective control, unanimous decision, right, by all those players who are having that joint control, right. So that's applicable to obviously both the categories as we understood so far, but importantly we now want to understand how is that control being managed. Okay, what is that you are controlling? That's an important question. Okay. And that determines the accounting treatment for the JOs and JVs as the case may be. Okay. So let's try to understand that part. I'm saying that, and we have used this example earlier, that there is a metro stretch, let's say of 50 kilometers. Two entities collaborate with each other, company X and company Y, wherein company X, let's say, is responsible for the 40% construction of this stretch. Okay. And company Y, of course, is responsible for the remaining 60%. Right. We refer this to as a joint operation because that is where both entities are involved in the operations. That is where they are contributing to the operations. And now what I would like to emphasize upon is that company X controls 40% of the operations and company Y controls the remaining 60% of the operations, right? And that is where you need to remember the word control and the accounting treatment thereof. Okay, something that we have done in the consolidations perspective under the Ind AS 110. Okay, what you control is what you consolidate. What you control is what you consolidate, which means that if company X is managing 40% of the operations, okay, that would mean out of the total assets, total liabilities, total revenue, total expenses, total profit, company X should control 40% and it should consolidate 40%. All right. Likewise, of these assets, liabilities, revenue, expenses, profits, 60% is controlled by company Y, and accordingly, 60% should be consolidated in the books of company Y. Okay. Now it is something like we may want to say it's a proportionate consolidation. Well, in the given case, it is. It is an example of a proportionate consolidation where you are consolidating only a proportion to the extent of what you are, of course, controlling. Okay. So yes, it can be, it is possible to have something called as a proportionate consolidation in this case. Okay. But then let's take yet another scenario. There is a metro stretch of 50 kilometers. Two parties, company X and company Y, are collaborating. There's a joint arrangement. Okay. But then company X is bringing 100% of the assets, for example, in form of machinery, in terms of equipments, and other resources. Okay. Company Y is bringing the technology. Let's say it's also involved in managing the licenses. It is also bringing the funding by means of, let's say, some loans, etc. Okay. And then let's say company X and company Y with a kind of effort, and they mutually agree that the revenue sharing will be 60% for company X and 40% for company Y. Say for the sake of argument, expenses also shared in the proportion of 60-40. Eventually, the profit is also shared in the proportion of 60-40, right? Now, this is again an example of a joint control or a joint arrangement. And within that, since there is a control on specific items, okay, there is a decision making done by, let's say, company X with respect to let's say the non-current assets, tangible part of it, and company Y has a responsibility for the intangible assets as well as the funding. Okay. And then of course the revenue sharing, etc., is also done as per the agreed proportion. So what are we saying is this is still an example of a joint operation. However, what you control is what you consolidate. You want to always remember that. Okay. So if company X controls 100% of those tangible assets, so in the books of company Y, so company X books, right, its own assets plus 100% of assets of the joint operation, they both will come. Okay. As far as its own liabilities are concerned, it would only have its own liabilities because the liabilities of this joint operation are managed by company Y. Okay. In the P&L, its own revenue, which is 100% of its own revenue, plus 60% of the joint operation will come. Okay. This is, of course, from the company X perspective. Own expenses, 100% plus 60% of the expenses of the joint operation. Okay. In the same way, of course, we can say for company Y, own liabilities plus 100% of the liabilities of the joint operation. That's the way we do the consolidation under a joint operation. What you control is what you consolidate. Okay. Neither of the party has 100% control over the operations. Otherwise, it would have been, of course, a parent subsidiary relationship. They have a joint control, not necessary proportionate. They have a joint control, but not necessarily proportionate. They may, by the way, as in this example that we discussed, if they are dividing everything in the 40-60, well, then they're allowed to do the consolidation in 40-60 proportion. But in real life, this is what normally happens. Each party brings its own set of expertise, its own set of, let's say, investments in form of assets or funding or operational excellence, etc. And accordingly, the performances in terms of revenue, expenses, profits are also being distributed like that. So that's how you start building the thought process of how do you do the accounting under the joint operation. All right. Versus that, when I look at a joint venture, okay, so when you look at a joint venture, how does it work? We say we follow the equity method of accounting. And you remember that equity method of accounting. We have discussed that in Ind AS 28, right? So when you say it's an equity method of accounting, simply put, whatever is your investment in the JV, of course, plus your share of equity. Of course, when you say equity, we talk about profits, reserves, etc. Okay, so that amount of whatever you invested plus your share is something that you need to reflect as your net investment in the JV. Now, why it is being done? Because you don't control the operations, you don't control the assets, you don't manage the assets. You're not responsible or obliged to meet the liabilities. Okay, so all you are interested in is the net assets in that JV. All right, and that is how you are able to correlate those aspects of what is the relevance of the word control and what is that you are interested in. If you're not controlling the operations, then you are very likely interested in the net assets. And if you're only interested in the net assets, it is nothing else but the equity that you are interested in, and you get your share of equity. All right. Now, Ind AS 111 does not go in detail as far as the accounting under the equity method is concerned. That is all driven by Ind AS 28. Okay, so we would like to remember that if it's a JV, you treat it the same way as you do for an investment in associate that we have obviously done separately already. Okay, so it's the same thought process which is brought in the context when you look at accounting under Ind AS 111. So what have we learned so far? We talked about when you look at a JO, share of control. So you bring those items in your balance sheet, in your statement of profit or loss, whatever you control, you bring that into the consolidation. The moment it is a JV, you look at, of course, the share of equity, of course, plus your own investment, right? So in this case, of course, the balance sheet and P&L are bulkier. You have more assets and liabilities, you have higher set of revenue and expenses when it's a JO because you control some portion of that operations. But the moment you look at the JV, you only bring the share of profit. Of course, this is where the balance sheet is. But in the P&L, as we have done the accounting under investment in associates, you get your share of profits as a single line in the statement of profit or loss. All right, that's how you're able to connect with the understanding, and you should appreciate that why this distinction is so important. In case of a joint operation, you still consolidate a lot of items, right? Under a JV, however, you only pick your share of equity or your share of profits and reserves, as the case may be, right? So that's a key distinction that you want to remember under the accounting for joint arrangements. Okay, let's have a formal look at these aspects and see how does it really work. Okay, and this is one area that we should be very comfortable with at this point in time. The moment I say joint operations, the parties with joint control have rights to the assets and obligations for the liabilities for the arrangement. Okay, so accordingly, you recognize your share of assets, liabilities, and whatever is the agreed proportion of revenue and expenses. Okay, that's how you determine. Now, that also reminds me that if you have a 60% investment and a 40% investment, so let's say there's a party A and party B, it does not mean that everything is getting 60-40. It's not mandatory. And in practical life, it is not the case actually. You normally would have different sets of elements within the balance sheet, and let's say also the statement of profit or loss where these consolidation will take place. Okay, versus that, now this is a straightforward accounting. Under a joint venture, you are interested in the net assets, so you necessarily follow the equity method of accounting there. Okay, now a very basic information that you should be carrying: Ind AS 111 versus AS 27 that used to, have this accounting managed under the topic. The initial topic AS 27 itself was named as joint ventures. Of course, now that's a very broader term in the earlier accounting perspective. It's now a part of joint arrangements, right? So joint ventures used to have a differentiation whether you have jointly controlled operations or jointly controlled assets or jointly controlled entities. Okay, so basis those, you would have consolidated your bits and pieces of information. We don't have to spend a lot of time talking about this, but essentially that distinction was not very clear under AS 27, where you are still talking about a proportionate consolidation broadly, right? So in a way, there was an expectation that when it is 60-40, let's say, between the parties, right, to the joint arrangement, everything is 60-40. Okay, so that was assumed to be the accounting when you used to have these kind of arrangements there. But in reality, in principle, that's not true. So that is where Ind AS 111 also became matured and the accounting was revised, whether you're looking at a pro rata or a proportionate consolidation or the true consolidation of the fact there. Okay, so a little piece that you should be broadly aware of, and that's about it. This is again the same perspective, the confirmation of, in case of a joint operation, you include its own assets plus the share of the assets within that joint arrangement. You bring your own revenue plus the agreed share of revenue. Okay, agreed share of revenue from that particular joint operation. Likewise, your own liabilities plus your share of liabilities. What are the liabilities that you are supposed to manage or you are obliged to, let's say, address? Similarly, expenses plus your share of those expenses which are agreed with the other parties. All right, that's something which is there. The recognition and measurement for each of the items shall be done as per the relevant Ind AS. Simply means if I have an asset from that joint operation, okay, I would want to say that this asset also has, for example, the application of Ind AS 16 if relevant, or 116 if it's a right of use asset, or maybe investment property. So I need to be following those accounting aspects depending on what category of that asset that I've received within or from that particular joint operation. Okay. That's what it is. I think we've discussed that as well, the proportionate consolidation versus joint operation. You should not be assuming, right? Do not assume proportionate consolidation if you see a percentage of equity, right? So it's unlikely. In real life, it is unlikely to have that, right? So just importantly, you need to understand that the accounting for a joint operation is not necessarily same as a proportionate consolidation unless there's an equal right to all assets and all liabilities. Okay, but in reality, it can happen that certain assets, one party has a larger control versus the other party, and same way, some other assets, one party may not have any control at all. The other party is contributing entirely to those assets. Okay, and the same goes with the liabilities. So accordingly, they are unlikely to be the same in real life, but conceptually, yes, they can be the same. Okay, so you need to be looking at those aspects, and of course, the nature of assets may also be different, and the nature of liabilities may also be different depending on those arrangements in terms of there's a contribution, you're going to get some money back, etc. So you need to be looking in those contexts as well. Okay, there is an example just to validate the accounting treatment under, let's say, joint operations. We are saying that D and E establish a new entity F. The legal form of the separate vehicle does not confer separation between the parties. Each party owns 50% of shares, but the contractual arrangement suggests D has right to all of the building number 1 and obligation to pay all third party debt in F. Okay. And then D and E have a right to all other assets and other equities, all other liabilities, sorry, in the proportion of their equity in stake, which is 50% each. So specifically, there's a building number 1 and third party debt, which is D's responsibility, right? So what do you control is what you consolidate. You want to remember that part. Okay. The second part of the question says that F's balance sheet is given as under. There is a debt of 120. There's an employee obligation of 50. There's an equity of 70. Cash of 20. Building number 1 is 120. Building number 2 is 100. Of course, there are total are 240 each. The question is, how would D present its interest in F in its financial statements? Okay. Now, essentially, what you want to remember here is this aspect and this aspect, for example. Okay. They are clearly with D only. Okay. And for everything else, it's 50%. So 50% of cash, 50% of the building, 50% of employee obligations, they would all be, of course, a part of, let's say, D's equity or D's balance sheet, for example. So that's the way you start looking at it. You should be consolidating only what you control. So essentially, when you look at the solution around it, right, you're trying to bring this perspective. A joint operator shall recognize in relation to its interest in a joint operation its assets, including share in the assets of the joint operation, its liabilities, including the liabilities that you assume for the joint operation, its revenue plus its agreed revenue from the joint operation, right? That's what it is. And its expenses, including the agreed proportion of expenses, right? That's how you start looking at it. As we said, the rights and obligations, etc., may differ from the ownership interest. The ownership interest is 50%. The building 1 is 100%. Debt is 100%. Others are 50%. You bring everything from that perspective, and accordingly, right, your accounting would reflect that aspect also, right? The entire debt of 120 and the building number 1, they both would come totally in the books of D. Cash, the other building, employee benefits, of course, the equity part would be only coming to the extent of 50% in the books of company. All right, that's how you start, of course, bringing this perspective, right? This is what we have discussed as well, but let's have a look at it in a more formal way. It says that when you are a party to the joint arrangement, how do you bring that accounting perspective for those assets and liabilities, etc., right? There's no difference in the approach again, right? So whether I'm directly owning, let's say, a property, plant, and equipment, or I have a interest in a property, plant, and equipment of a joint operation or in a joint operation, the accounting treatment is the same. I mean, they are both property, plant, and equipment, right? So the only question that remains is that whatever is the value of the property, plant, and equipment, I'm bringing in my books. Whatever is the value of the property, plant, and equipment, I'm bringing in my books. That is where the measurement of that account, measurement of that asset comes into the picture. Okay, my accounting treatment would be exactly the same the way I do it for my property, plant, and equipment. For that matter, even that asset, the property, plant, and equipment within that joint arrangement is my property, plant, and equipment to the extent of my control. Okay, so accounting wise, there is no difference. And we say that joint operators are required to recognize their rights to the assets and the obligation to the liabilities as per the relevant Ind AS. Okay, so all you need to be carefully assessing is that whether the asset would fall within the perspective of Ind AS 16 or Ind AS 38 or Ind AS 116 or maybe Ind AS 40. So you start bringing those aspects into consideration when you are trying to highlight that part for accounting purposes. Okay, this is again we have discussed. As far as joint ventures are concerned, it's an equity method. Ind AS 28 governs the accounting. So that's where the application would be covered through that particular standard with some exceptions. For example, if the entity is a parent and is not required to prepare consolidated financial statements, what we have discussed, exceptions to consolidation, right? When should you not be consolidated, right? Specific aspect you covered there. Or if the investment is in a associate or a joint venture, wherein it's coming through a venture capital or a mutual fund, where it is presumably, you're rather trading in the investments. You're more interested in the value of the investment, and you're not looking at a long-term perspective, right? So in those cases, you may elect a FVTPL, right? What we have learned in Ind AS 109 financial instruments. So those investments would be allowed to be measured under the FVTPL category. And in that case, of course, equity method may not be applicable. Okay. Disposals, yes, if you sell something, then you de-recognize everything, of course, right? So as good as a sale of a subsidiary in case it's a joint operation. So you will de-recognize everything from your books, and of course, whatever is the gain or loss, you shall recognize that amount in your books as well. As far as a joint venture is concerned, it's a disposal of course, an investment in associate from the accounting perspective, and of course, you discontinue with that equity method and you de-recognize any interest, whatever is the value of the investment so far. If you're getting something more, you show a profit. If you get something less, you of course show a loss, right? You are not required to. This is a very straightforward thought. I mean, you just sold something. Okay, do you need to restate the earlier or the previous financial statements? Answer is no. It's just a disposal. Okay, it's not a change in accounting policy. It's not an error. So you're not required to restate the financial statements at all. You would continue to show, and it's important for the users to understand that there was something in the past which is not there, and it has to be visible through, for example, let's say the financial statements. Put it like this. I'm saying there's a company X, okay? It has its own assets plus assets of the JO, proportion of the assets. Let's call it 1,000 and let's call it 200, okay? So you continue to show them at 1,200, okay? And of course, you charge depreciation, impairment, etc. And that's the way you have been doing it. But if you sell this JO, right, this entire 200 will be going away. So the question is, the statement is trying to say that, should you restate as if this 200 was never there? Of course, you don't do that. You rather should be very clearly mentioning that whatever is the value of that 1,000 worth assets, let's still use the value of 1,000. You would now say, earlier I had 1,200 worth of assets, but since I disposed the joint operation, I'm only left with 1,000. And that is what is probably a very transparent information to the users of the financial statements as well. Okay, so it makes more sense for the users to actually see that there is something which is gone. Of course, we are seeing it from a JO's perspective, but the same thing would apply in case of a joint venture or a JV as well. Okay, so there's an investment that you would have shown in your balance sheet, and that's gone because you sold, right? So that has to be reflected, and it is not restated because it was there earlier. It has changed now. Okay. Importantly, what we want to briefly discuss is about the continuous reassessment in terms of whether that collective control continues to stay, right? So that's what you need to kind of be looking at it, right? In case there's a change in a legal form, in case there's a change in how the activities are directed, and when I say activities, we are referring to, of course, the relevant activities part, what we discussed earlier, right? Change in other facts and circumstances, etc. And accordingly, you need to reassess whether that joint control has taken a different shape. Okay. So, basis all these things, you need to be doing a continuous reassessment, not something which is very critical from an examination standpoint, but conceptually you should be aware of the thought, and that's the reason why it's very, why it's covered in a very brief manner in given scenario. Okay, the final section that we want to discuss now is the differences between Ind AS 111 and AS 27. One of the differences we have already covered, right? So let's have a look at that formally, right? AS 27, we had three broader types of joint ventures, but Ind AS 111 only refers to a joint operation or a joint venture, of course, which are two different types of arrangements, right? From a definitions perspective, we use a word joint venture, but here, of course, we're using a joint arrangement. So it's not very, it's a key difference or a critical difference, right? Now, this is what we discussed already. This is clearly covered through a proportionate consolidation method, but a joint venture specifically, within the Ind AS 111 framework, is covered through the equity method of accounting. Okay. Likewise, we expect that the reporting dates between the party, that's the primary entity, and the joint venture must be the same, but it may go up to 6 months of time, and adjustment needs to be made, for the effect of significant transactions, right? In case of Ind AS 111, the only difference is that we need to ensure that the difference is not more than 3 months, right? That's it from my side on this particular topic. Thank you very much.